Welcome. I'm David Phillips, CEO of Estate Planning Specialist, and I'm joined today with Rick Durfee, the founder and senior partner of the Durfee Law Group, Melodie, Gatz, changed her name on me, got married. She is the CEO of Legacy Global, and Todd Phillips, who is our president of Estate Planning Specialists. So good to have you join us today. We're going to talk about the impact of the 2020 elections on your estate. Boy, a lot's happened. Lots happening here in Arizona, and we're going to talk a little bit about that. We're also going to talk about year-end planning. We want to make sure that everybody understands we're in the last quarter of the year. In fact, we're in November right now. We're talking to you right after the day after the election, and so we kind of wanted to give you a heads up on what to do as far as year-end planning and make sure that you don't miss a beat. You wake up on January 1st saying, oh, I forgot to do that. So we'd like you to all be aware of what things to do and what strategies that you need to try to implement before you're in. So I'm going to first start out with Rick. Rick, we've had a whirlwind here in Arizona specifically. We have Georgia. We know Georgia is going to go into a runoff.
And in Arizona, they're still trying to find people who know how to count.
Yes.
They're working on that. Hopefully they'll figure it out.
We have some big ballot issues and some polling issues. Who knows? But right now, we don't even know who our governor is going to be for the next little bit. Mark Kelly looks like he probably has a little edge over there in on Blake Masters, and so it looks like that's probably going to tip that scale a little bit on the Senate. Most of the tax issues that we've been talking about that we were so alarmed at last November when the House Ways and Means Committee was coming up with some design on changing things. Most everything's pretty well status quo, I'm kind of feeling. The tax brackets are the lowest they've been in 80 years, income tax brackets. We've kind of dodged the capital gains bullet that we were so afraid of. So some things are looking pretty comfortable for the next little bit. What's your take, Rick?
So I think the voters have made it clear, and this is one of the consequences of a divided Congress, or at least a balanced Congress, is we would prefer it if you did very little, maybe even nothing. And it's kind of looking like that's the ultimate outcome here, which for estate planning, like we're going to be talking about here, that gives us some breathing room. There's some changes scheduled that are going to happen if they do nothing. And before those happen, we have time to plan, to think through, and be deliberate in what we do. So I think we have breathing room before big changes are going to happen.
And I think one axiom is back to estate planning, or focused on estate planning, is it's the estate tax laws that are in place when you pass away that matter, not so much the way it is today. I mean, right now we have a federal exclusion of $12,060,000.
Right. That's going to sunset in a couple of years.
Yeah, on 2026, January 1st, 2026, if they do nothing.
If they do nothing, and that's the law on the books. So the most prudent thing is to plan for the law we have, not the law we think we're going to get if somebody does something.
Right, exactly. So one of those big laws that we have that's in place is gifting. Yeah. We can gift. We can gift assets out of our estate today to our children, to our friends, if we want to anybody really. And right now the gift allowance is $16,000.
That's the annual allowance.
Yeah. So tell me, should we do that now? Should we wait? What should we do?
Yeah, well, obviously, it depends, of course, on the size of the estate, what you want to do. But some pushback we get all the time on this gifting thing is, well, I need this money. I don't want to give it away. So one of the points of effective estate planning is you can give things other than cash. And you don't just have to enrich generation 2 or 3 by, oh, here's a check, here's a bunch of cash, have fun, kiddos. You can use other devices, limited partnerships and LLCs. You get many advantages from that in addition to the use of the gift exclusions. You can have discounts, you get control, you can have consolidated multi-generational investments, so you get some economies of scale and other things that make sense. But should we use the gift exclusions? Most of the time. And in this window of time we have here from now till the law is going to sunset, we should grandfather in that $12 million exclusion if we're in that category. And an interesting thing I'm seeing, this has happened a lot in the last few months. And part of the reason I'm sensitive to this is because it happened multiple times today, where people said, 2 years ago, my estate was way below the estate tax exclusion, but with runaway inflation, with real estate prices jacking up, suddenly my estate that was this big is now this big and growing and cash flowing. So people who didn't have an estate tax issue before do now.
Yeah.
And I think there's going to be more of that.
Well, and especially if they drop it down to the 6 million, or yeah, we'll see a lot more people.
Interjecting that anybody focused on building wealth long before you get close to the estate tax threshold should be planning and instituting in their business and estate plan means to make those transfers long before the wealth has grown to that threshold.
Make the moves.
Yeah.
Make the moves now instead of waiting until.
Plan for where you are growing.
Yeah, the estate taxes are only paid by people who screw up, who really don't plan, who are thinking, oh, I hate lawyers and CPAs, I'm too smart, I can build all this wealth and it's all mine and I'm going to give it all to my kids, and they don't know that Uncle Sugar here has got a plan to take a big chunk of that. So if you're looking forward and actually thinking about what are the real world consequences to my accumulation and development of wealth, you're going to plan for that way in advance and it won't be an issue.
We're talking about transferring. So Melodie, you're with Legacy Global Foundation, and what about year-end gifting? Of charitable gifting.
Well, charitable gifting is often a wonderful way to support both the organizations and causes that you care about, but also to deal with some tax issues. And we have a hard deadline for any deductions in this year. I know that there's been some interesting activity in the markets, but particularly for highly appreciated assets where it would be good to diversify, where a 1031 may not be the appropriate move, doing some or all of those types of assets as a charitable gift can maximize the tax savings and allow the diversification of the portfolio without realizing any of the capital gains tax. So sitting down with your estate planner, with your CPA, talking to groups that can take non-cash assets along with the cash. I think a lot of people right now want to focus on maintaining their cash so they can take advantage of the opportunities that the market turmoil has given, but the charitable gifting with that hard deadline, and it takes more than just writing a check if you're doing it efficiently
correctly
with these alternative assets. It takes talking to people like the group that I run, like Legacy now, and saying, let me be efficient with my resources and make gifts of what's being either underproductive or overvalued that we'd like to diversify in the portfolio and keeping the cash within the family estate.
So I want to observe something on that, because another recent interaction I had was with a CPA who, to his credit, recognized there's an issue here, something needs to be done. I don't know what it is, but I know people who do know. And so there ended up being a conversation with a larger group of advisors, many of whom, other than me, but including me, but who could bring some solutions to the table, like some of these charitable ideas that here's some options to consider and weigh whether or not it makes sense in this case.
Yeah, and the standardized deductions with the simplified tax code have made it so some of the smaller gifts are not as effective, which is why I'm talking to the alternative assets in particular, appreciated things of value, whatever they are, because it's important to recognize that you can utilize that charitable gift both in this current tax year and any unused portion in the beginning of next year to work with realigning your estate and portfolio
Rebalance.
Yeah.
to
And I always kind of go back to California, but there's other states like New York, with the huge capital gains tax that's added to the federal, and any appreciated asset that you have that you are ready to move, that you need to move. It's real estate that has become a burden to you or whatever, and you need to move it, but you can't move it because of capital gains, and you don't want to lose a step up in basis. You got to talk to legacy. You got to talk to you. Firms like yourself, you need to understand what the options are, because a charitable remainder trust and charitable giving, it all kind of works into the process of, now you've got an appreciated asset, what do I do with it? So go ahead.
Well, let me just top that off with, I'm seeing a huge number of companies that are doing capital raises by allowing investors to invest through their donor advised fund or through a philanthropic vehicle, which allows people to support startups that have impact that they want to see in the world. The gains will go to the charitable account. So it's important to note this is not a way of creating more wealth in the family, but I'm seeing a lot of founders of companies who are being very successful at raising capital in partnership with us by raising it from philanthropic accounts, because something I think people don't realize is charities can invest in the private markets as well. And that's one of the biggest growth areas that I'm currently seeing, is not just taking in gifts of these assets, but utilizing them to invest in the private markets
For impact.
Where it aligns well. And that's being a very effective.
And I will note, because I know you do this, sometimes the desired impact from one donor to another is different. And it's really cool to see that you can structure the impact to be consistent with what each particular donor wants, because one may want to favor one social cause and somebody else may want to favor another, and you don't have to be locked in. You don't have to use the social impact that somebody's trying to hustle you or sell you. You can design that yourself.
So let's switch gears for a second. Year-end planning, though, still there's another planning strategy that we've got a time constraint on, and that's the Roth conversion. So Todd, tell us a little bit about a deadline there, and when should we do it, and why? I mean, what's the advantage?
Well, obviously the year end, December 31st, if we're going to do anything this year, we got to do it before that deadline. The market's been hit pretty hard. People are down on their portfolios 20, 30, 40%. So it's a great time to convert your IRA while it's down, pay lower tax, and then hopefully the market will rebound. I was just looking at some information chart from American funds. They did a study looking at the year following the midterms, and they went back to 1950, and the average return after the midterms was 15.1%. The average,
and the market was up 1,200 today.
And the normal,
Wow, based on the outcome.
Yeah.
The election.
yeah, and the normal average return is 7.1. So just to show that, and there wasn't a single year since 1950 that the midterm had a negative year.
Yeah. Regardless of political party power
Regardless,
or
didn't matter.
divided.
Yeah. So that's interesting. I mean,
So people are happy with that midterm outcome. Is that what that means?
I think it says that usually they can't get anything done. And so, because usually it's a change of power,
Okay.
and in those midterms.
So wait, the politicians are busy reconfiguring how they're going to punish us in some fashion. So while they're all otherwise occupied, let's hurry up and do. Yeah, okay.
So, but yeah, that's a really bullish.
So what's your point though on the Roth conversion?
Well, now the market's been hit. Take your money out of your IRA, convert it to the Roth, and then if it does rebound, you're out and you're growing in your Roth versus your IRA.
So you minimize the tax and maximize the return.
And I think one of the things we've stressed, and in the Bombshell Battle Plan special report that our viewers can get by going to the website, we've stressed doing the management, the tax bracket management.
Right.
And, we're the lowest brackets we've been in 80 years. We need to take advantage of that. And I don't see, with the midterm the way it ended up, I don't see the brackets changing.
They're not going to go down, that's for sure.
They're not going to go down. And I don't think they're going to go up. I think they're going to stay until 2026. I think we got 2 more years of this glorious window.
A 2-year stable time.
Yeah.
When they're not going to mess with us, because long-term planning is tough when you don't know what the rules are.
Yeah.
So
But if I'm a joint earner,
pushing upwards regardless of brackets, though, that makes it even more critical to utilize.
Act now.
Yeah, because if I'm a joint earner and I could take right now this year $340,000, and the top bracket that I would pay would be 24%. So my effective bracket would be what, Todd, about 18 over that period of time.
The same thing.
$340,000. That's quite a bit of money you can pull in at 18%.
Yeah, the same idea of act now while the values are down also applies to the previous question of gifting. Why should we gift now? Because it's better to gift when
point.
values are down, so you get the low value out of your estate. The high value then comes after it's out of your taxable estate. So that's.
Here's another interesting deal on the election that I didn't really know, because I don't live in California. We're here in Arizona, and there was a proposition called Proposition 30 in California, and it didn't pass, and I'm surprised. It said tax the wealthy. If you make over $1 million, they're going to do an excise tax on the rich, and it didn't pass.
So maybe they watched what happened in France and a lot of other places when they did such things. There was capital flight like crazy.
So that's kind of refreshing, and on that one end, because I honestly, when I saw that was there, I figured, well, I assume that one's going to go down, but it didn't pass. So
California has debated having a tax for 10 years after leaving the state to prevent.
Well, that's true.
I'm
Well,
sorry,
New York
this is a little
that.
vulgar, but if your dog is in one state and does his business over the state line into California, they'll tax it.
New Jersey has that. New Jersey has that deal though. Too.
Yeah, they're very aggressive. If you leave the state, they go, but you were here once.
Yeah, which kind of another little side note that didn't pass this year, but it was last year. Washington State, or 2 years ago, Washington State passed a legislation, or actually implemented it. It became effective this last September, right, Todd?
Yeah.
Called the Washington CARES Act. It was passed several years before. But anyway, the idea is that they are going to create a fund for long-term care. And you can qualify for it if you're like totally destitute, you have 4 of the 8 activities of day. I don't even know what 8 activities of daily living are, but anyway, you have to, it's a little tiny window and you can qualify for it, but you have to pay for it now while you're employed. So if, they're forcing people, and it's going to be a payroll tax that's going to come out, and it actually is happening now. And states like California and a couple of other states are seriously looking at doing the same thing, forcing people to have a long-term care plan that really nobody wants because it's not good.
Well, I know some people who, with good reason, qualify for such plans, and the process of getting qualified and then staying on there and what that does is not healthy for those who even are able to qualify at some point. It's not good care.
Right.
And it's a pretty nightmare process to...
You offer private solutions to address these needs, and are we surprised when the government alternative to good, healthy personal planning, when the government substitute is less quality, lower standard than the private solution? Does that surprise anybody? I mean,
in fact, if we learned one thing we learned a lot of things from COVID, I think, and that's a debate for another day, and we don't have time to do that. But one thing we did learn is that you don't want to be in a long-term care facility with COVID. So, the first year.
Well, you won't be there for long.
Don't worry. That's right. 40% of all those that passed away in the first year, in the first year of COVID, were in long-term care facilities. So you just don't want to do that. You want to be home. You don't want to be, take care of Todd. I know that there's a couple of things going on in that realm that you wanted to talk about real quick.
Yeah, I was gonna. I mean, just in that realm, I guess we want to talk about the long-term care aspect. We kind of got our socks knocked off when we saw the new rate. So there's a new long-term care annuity that is paying 6% fixed rate, which is the highest fixed annuity that I know of right now. I think the highest other ones I've seen is about 5.5%.
That's 6 for how long? For
6%.
life?
Well, it's for this year, but it's slated to stay that high. And they could drop it later, but it is at 6%. And then it's buying a fixed annuity that then is getting 3 times the annuity amount, the value for long-term care. So if you put in $200,000, so husband and wife, $200,000, they're getting $600,000 of long-term care.
Is that plus interest?
Plus the $200,000 earning 6% interest. Now there's some of the cost of the interest earned is going towards the care. So they might be netting out 4%. But I mean, we used to be seeing 2, 1.5%.
But they have the care.
But they have the care. Now we're seeing 6%.
They have 3 times care.
Yeah.
And 3 times, and it's growing. So as the 200,000 is growing, the long-term care is tripling as well.
And you can be cared for in your home. You know.
Use it.
So if with interest the 200 grows to 300,
right?
You get how many times?
900,000.
Okay,
You'd always give me 3 times.
So it's
more.
3 times whatever the value is in
Right.
the annuity. Wow.
So there's been that. There's a lot in the on the annuity front that I've just been blown away. I mean, they were high. I remember talking in our meeting back in August. I was surprised at how high they were, but now it's just because the Fed just keeps raising rates. This last raise, I just got one. We had a big change today, so we'll be seeing on the 15th. Usually they do it by mid-month. Some really nice rate hikes on the annuities as well. So we're like in the reverse. The mortgage guys, we're in the opposite now, where they were refinancing like crazy, and now we're
Yeah.
One of the benefits of the higher interest rates, they're harmful to those trying to purchase real estate, but they are beneficial to those in these fixed income products.
We're finally now retirees, and this biggest thing is they're getting paid to save, and they're actually getting yield. You're just thinking about it, taking $1 million portfolio can then just get a fixed guaranteed rate annuity for 5.5%. That's $55,000 a year, and not touching the principal. We couldn't do that last year.
And that's guaranteed for 5 years, right?
Yeah, guaranteed. Well, you can guarantee it for 10 or longer, but you can get it for 5 years at least locked in. You're getting 5.5% for the next 5 years, and taking no risk and not touching your principal. Savers are now finally getting a chance to get some yield. Now, I've seen heard the Fed's going to be raising rates again in December, but then should hold off. The plan is to hold off for the first of the year. So there's no plans to raise.
But right now is a good time to jump into an annuity.
Yeah.
Right now it's like, yeah.
Yeah, and the other thing I'm seeing a lot of is people basically are revamping their old annuities and getting, because the rates have jumped so much.
Yeah, so if you get a higher rate.
So instead of refinancing like you would your loan, now we're re-annuitizing. You're really upgrading. I'm seeing a lot of the older products with a 1% cap, 1% interest rate, and maybe a 3% cap on the S&P. Now we've got 5.5%, 5% fixed rate, 10%, even 12% on the S&P for the cap.
On the upside.
On the upside. So lots of upside. We're seeing I've got this one we call it it's a trigger strategy, and it basically says if the S&P is up at all, you make 10%. If the S&P is down, you get 0. So think about that. We just went through how often the S&P has been up every year in the midterms. It's been up since 1950 on the midterms. The year following the midterms. If it's up at all, you make 10%. If it's down, you get 0. So the strategy is put half of the investment in the fixed, making 5%. The other half in the trigger strategy, you make 10. So you're averaging around, and if it's down, then you get 0. But the odds are that's probably going to be up. We'll say no loss to you no matter what happens. You don't have to take risk anymore with these rates. You just don't have to do it.
And I think, and you know, one of our friends and guys that have endorsed all of us here, Mark Skousen in Forecast and Strategy, said that now is a good time to take some chips off the table. And you know, I love playing blackjack with Jane behind me. You know, she's always grabbing my chips, and I never. What happened to my winning? But that, you know, at least I could walk away with something. And now's a good time to take some chips off the table. So
yeah, there's a lot of really great things to look at now. But yeah, I was saying upgrading the annuities. I'm seeing people, you know, there's bonus plans too, where I saw one. I mean, there's 10%, 11% bonus. So maybe you have a 1% surrender on this annuity that has a 2% surrender charge. We've seen that, like maybe the 2% surrender charge, they get an 8% upfront bonus plus much higher rates. So it's almost like a no-brainer. Like, wait a second, this is.
Well, good. Well, look if you're interested in any annuities, give Todd a call here at the office, and you know, at least make an appointment with Todd. I mean, you know, you've been very busy lately, and so Melodie, I know you wanted to cover one aspect of some of the gains in some stocks and whatnot. I know
the gains and some of the losses.
The
I'd
losses,
say. I think
yeah.
that the news in the last week or two on markets, on some of the milestones, Amazon losing $1 trillion of market cap, so to speak. I would say value, but it's not really value.
It was fluff.
Yes, fluff in the market. The FTX exchange pretty much going belly up. They're still considering how the bankruptcy proceedings will happen. Tesla,
which is the Bitcoin.
Yeah, in the crypto markets.
Crypto, yeah.
As an exchange there, which impacts lots of currencies in interesting ways, and a lot of the big investors into crypto. Tesla losing quite a bit of their market share in.
So what's your point?
The overall point, yeah, the getting out is there's all these really interesting plays going on. And at the end of the day, one commonality between the companies losing the values is their valuations in the market, which is different than the real underlying values. The valuations that the market has gave them prior to these movements has been wildly higher than the actual revenues of many of these companies. And I like these companies. I'm a big fan of crypto. We do a lot with on these exchanges. I'm a big fan of Tesla. I utilize Amazon myself. I think nearly all of us do. But in rebalancing a portfolio, looking at a company's fundamentals, what are the actual revenue streams coming along? I think that that's probably a really good baseline for anybody who is looking to stop the carnage that they've seen. Because on the one hand, we've seen massive losses in the market this year. On the other hand, there are a lot of people who have still made a lot of money and still have a lot of gains. And it really comes down to fundamentals. In an inflationary period, in a volatile one, looking to align your investments with where there is value and cash flows.
So that's something to just comment from the lawyer's chair. I don't manage anybody's money, but I hear a lot of people talk about it, and this kind of ties to what Todd was saying about annuities as well. I see more clients less interested in what investment is sexy or cool, and more focusing on what's going to cash flow. Where's it going to cash flow? Where's it going to cash flow? And so a high yield annuity, well, it's going to cash flow in a predictable way. Or other investments that we can look at and say, there's the cash. It's going to flow like this. People are looking for that.
Yeah, and I don't manage money either. I'm speaking from observing thousands of different advisors and accounts in different asset classes. There's safety in what's cash flowing, whereas their actual revenue. That provides a weathering for the volatility that we're seeing, which may be different than saying, hey, I think that I think that corn is going to go up because I know what the market's like, and you might. But most of us are not farmers, and we don't know that much about the market. We don't want to follow the crowd.
Corn futures are just a bad joke.
Yeah.
Well, I think that kind of ties in with you, Todd, with the annuities. I mean, there's safety there, and places we can go to weather the storm, and it's there. It's also in permanent life insurance that through the family bank. Which, by the way, I wanted to just invite everyone. I just finished rewriting the family bank strategy revisited. It's kind of rather than rewrite my book, the family bank strategy, I did this addendum to it, or special report, and our viewers can call in and get an update on that, on the family bank strategy, which is a way in which you can accumulate tax-free wealth and have it distribute out to you tax-free. At the same time, tax-free distribution to your family. You can make it income and estate tax-free to your family. At the same time you're doing that, you're accumulating this wealth, and in a tax-free world, it's in a safe world. There's no risk involved in this one here. So in the family bank strategy, it's risk adverse and very similar to the annuities. Well, we got to close out today. Not much has happened again in our election results. It looks like we're going to probably, the Republicans are going to control to some degree the House. Some of the things that they'll want to vote on may not get through. They're going to, they'll end up on Biden's desk, and he'll veto them most likely, I would assume. And the Senate, who knows where the Senate right now, today we don't know. It's going to be 50-50 or 49-51 or whatever. We don't know today. So just hang on. And Rick, did you want to say one last thing before we close out today?
Amen, hallelujah, pass the ammunition. That's it.
Okay, very good. Todd, anything?
I think you covered it.
Okay, great. Melodie? Good to have you here today. And if you, anything that you want to discuss with us, give us a call. We'll, at the office, set an appointment with myself, Todd, Rick, Melodie, and their offices, and we'll give you a hand and help you with your estate planning. Year end, you got to do things. If you're going to do any kind of gifting, if you're going to do any transferring, and you want to do it before year end, you got to do it before year end. Those things you have to.
Yeah, anybody who's got a year end deadline, don't call me after Thanksgiving. Just don't call. It's not going to happen.
Thanksgiving, that's only in 2 weeks.
I don't call now. That's it. Don't mess around if you got to get it done before the end of the year.
Yeah. Okay, well, good. Thank you. Have a good day.